Hi, I'm John Graham. I'm a finance professor at Duke University's Fuqua School of Business. I'm also the director of the Global Business Outlook, which is a survey we do each quarter jointly with CFO magazine of chief financial officers around the world. This quarter we had more than 800 respondents, about half in the United States and the other half spread throughout Asia, Europe, and Latin America. Our partner in Europe is Tilburg University, and in Latin America is FGV in Brazil. So I'm going to give you an overview of the survey results today, but there's much more information you can find at cfosurvey.org. So we'll start with the US, and then I'll put it in a global context. So the US, we have some good news, some not so good news. Optimism is down in the US a little bit, and business spending plans are also down in the US. At the same time, we're seeing employment numbers actually should remain fairly strong in the United States, and earnings should remain fairly strong. So we're going to talk a little bit about how this can happen at the same time. So I mentioned that optimism is down in the US. Well, compared to Asia, optimism fell even more in Asia. Now, if we talk about Asia, in general, it is comparable and even stronger than the US across the board, both in optimism and employment and capital spending and other categories. But the gap has shrunk considerably between the US and Asia this quarter. So things have softened a bit in the US, softened even more in Asia. Likewise with Latin America, the situation is still growing more rapidly than in the US, but things have softened a bit. In contrast, in Europe, it's basically flatline. We're seeing no expected growth in employment, cuts in capital spending, optimism's down. Basically, Europe is mired in recession, and when you're in a recession, that's when you do things like cut business spending. Let's circle back now and talk about the US is expecting 2.5% growth in employment. All right, so if the US successfully adds 2.5% more domestic full-time employees in the next year, that would actually push the unemployment rate down below 8%, near 7.5% by this time next year. That's much stronger employment growth than we've heard out of the government statistics lately. So government statistics look backwards in May and April, for example, and the predictions we're getting out of the US, or out of the CFOs, excuse me, are what they project to happen over the next 12 months, okay? So CFOs are expecting to continue hiring over the next 12 months, even though the government statistics have indicated a little softening in employment in the past couple of months. So that would be a real strength and show some real resilience for the US if that were to happen. 28% of CFOs in US companies tell us that their employees right now are maxed out, working at full capacity. And because of that, that's why they're trying to add to the workforce to kind of lessen that workload a little bit on their employees, even though the economy is slowing a little bit. In contrast, only 12% of US companies say that their physical assets are maxed out. So they actually have some unused capacity on the plant and equipment side that they think they can kind of grow without having to spend as much, which is why capital spending is only expected to go up by 5% in the US over the next year, down from 7 or 8% that we had heard in previous quarters. Now, we explored several other issues on the survey. For example, we asked companies, how innovative are you in your spending? Are you trying to pursue innovation within your budget? And about 4 out of 10 companies in the US said, yes, they are spending on innovation. Among that 40% of companies, they're spending about 3% of total budget on transformational innovation and about 6% on mid-level, kind of medium growth type of innovation. Now that's going to vary by industry, and it'll vary by country also. So for example, if we look at Asia, about 4 out of 10 Asian companies are spending on major innovation, but they're almost spending at twice the rate on transformational type innovation that'll bring their company up to the next level. That partially reflects the type of industries that are booming in Asia, but it also reflects kind of the more rapid growth that's occurring in Asia. Another topic we touched on this time is business corruption, in particular, for example, fraud or bribery. Not much of a problem in the US, where about 8% of companies say they experience problems with business corruption in their operations. Whereas in Asia, about 35% of companies say fraud and bribery is a problem. And in Latin America, nearly 3 out of 4 companies say business corruption is an issue. Now, what are the consequences of this? Well, CFOs tell us it leads to higher prices, lower quality, less competition, slower overall economic growth, and less tax revenues collected by the government. So it's an interesting contrast that the regions of the world that are growing most rapidly, these emerging economies, are also struggling with just basic corporate governance and business standards. So this is an issue they'll need to resolve going forward to continue the rapid growth into the indefinite future. Finally, we also asked about cash holdings. What a lot of people wish is that companies would start spending this cash that we see on the balance sheet and just have the economy, give a real jump start to the economy. Well, the problem is companies don't really want to spend the cash unless there's a good reason to, okay? So for example, demand is somewhat weak right now, so companies are holding on to cash. In fact, 52% of companies tell us they're going to continue to hoard cash. This is in the US. And it's because of weak demand, because of concerns and uncertainty about the economy, because of concerns about the banking sector, liquidity, and really just because there aren't that many great investments out there right now. The other 48% of companies that will start to spend their cash, the good news is they are going to spend it on capital spending. We talked about that 5% growth, and on making acquisitions. About a year or two ago when we've asked this question, we heard more about using the cash to make share repurchases, which is fine, but now we're hearing more about kind of productive use of the cash, which is good news. So to sum up, the world economy has slowed in the last quarter. There's some resilience in the US. I mean, things are slower, but we see some resilience on the labor market side, which is good. In Asia and in Latin America, they're still outgrowing the US, but the gap has shrunk over the last quarter. In Europe, we're not seeing good news. We're seeing a really stagnant, recessionary economy. Now, I looked around and tried to find some good news about Europe. And the one thing I spotted was that in Europe, the CFOs say their optimism about their own companies has not gone down this quarter. So what I interpret this to mean is while the headline news is bad, and there's a lot of bad news in Europe right now, companies feel like if the macroeconomic and financial picture can improve in Europe, that the companies feel like they're ready to be productive again as soon as those big picture issues are addressed. Okay, that's it for this quarter. We'll release another survey in September. Thank you.